Hello, scholars. My name is Joseph AGK Orji. The topic of our lecture today is capital asset pricing model. I will start by sharing my screen with you, and then we go from there. Excuse me. So I believe you can see my screen now. Yeah, you can see it. Okay, good. So the capital asset pricing model, the simplest way to explain this is that it is used to describe a relationship between risk and expected returns. So, and it's also used, actually, let me put it this way. The model describes the relationship between risk and expected return. Then how do we use it? We use it to price risky securities. So there's a few things you need to know about this capital asset pricing model. Those things are very important. First one is that the general idea behind that model. That idea is this, that investors need to be compensated in two ways: time value of money and risk. So the time value of money aspect of it is represented by the risk-free rate in the formula for the capital asset pricing model. We'll come to that in a few minutes. And compensate investors for placing money in any investment over a period of time. So another thing we need to know about this model is that the other half of the formula have two halves. The other half of it represents what is called risk. And what does it do? Well, it mainly calculates the amount of compensation that the investor needs for taking any additional risk, So, and to do this, the formula can help in calculating the, we take the risk. It helps us to take the risk measure, which is what we normally call beta, that compares the return of the assets to the market over a period of time. And then also the market premium of it. Well, Now, sometimes, this is another important thing we need to know about the capital asset pricing model. Another name for it is the security market line. So, either we call it the capital asset pricing model, or we call it the security market line, because both terms are used for the model that compares the risk of a security, which is the beta, to its required rate of return. Okay? Now, at this point, we are ready to take a look at the computational formula for the capital asset pricing model. The formula goes like this. The expected return, or the required rate of return of that security. When I say security, of course, I mean stocks. Okay. So the expected required rate of return, that security, RJ equals RF, the risk-free rate, plus beta, which is the market's risk. Then in parentheses, we have market return minus risk-free rate. Now for the risk-free rate, we use a return on any of the treasury bonds. Usually we make use of US treasury bond, return on it. Why do we call it risk-free rate? Because US have never defaulted on their bonds. So we call it risk-free rate. So for the risk-free rate, we use that return on that treasury bond. And I'm going to show you how the treasury bonds looks, the appearance. Okay. To do that, I'm going to open a new space, a new page. Okay. we can use the return on those bonds. What I'm going to show is the type of bond treasury security that I'm referring to. So I'm going to use this Yahoo Finance, and I'm going to go all the way to where you have the return on the treasury. You can see the 10-year bond here. So you can use the return on this, you can calculate the return on this 10-year bond to calculate your risk-free rates using the historical data. You can see the historical data. You can use it to calculate the return. Or you can go direct to Treasury website and get the return on that bond. Okay. Now, then for the market return, you can use the return on any of the market indexes. This is like the S&P 500. You can use it as a market return. Then for beta, we can use the beta of the stock to get as our beta. Now, in my previous lecture, I explained the meaning of beta. In the lecture that I will deliver after this one, maybe tomorrow or next, I will show you how to calculate beta. However, for most stocks, the beta is actually in some website like Yahoo Finance. I'm going to use Walmart as an example. Suppose I use WMT for Walmart, and you can look at the beta where it is located. Okay. Make sure you're seeing this. Yeah. Okay. So you can see when you look at the statistics, you can see that the beta is you can see the beta 5-year monthly for beta is 0.53. This is not a static number. It changes, depending on how risky the stock is. So this is for 5-year monthly. This is 0.53. Okay, that means it is less volatile than the market. That is for Walmart. Okay, now having explained this, for the risk-free rate, we use the return on 10-year treasury bond. For the market return, we use the return on S&P 500 or any of the market indices. And for beta, we use the beta of the stock. Now, for most questions you see in the finance classes, you'll be given these values. The question will give you the beta, give you the risk-free rate, give you the market return, and then it will ask you to calculate the expected or required rate of return on that security. Okay. I want to say more things about the security market line before we proceed. And the security market line, actually, like I said, either you call it capital asset pricing model or you call it the security market line. Now, let me give you the reason why it is called the security market line sometimes. Why? Because it is a graph that actually represents the capital asset pricing model. What does that mean? What I'm trying to say here is that the security market line serves as a graphical representation of the capital asset pricing model. And it looks like this. I'm sure you can see it. Yeah. Now, so this is the line right here. Any stock that is has value that is greater than this line is considered to be undervalued. And the one that is, they will have the return that is below this line is considered overvalued. That is, any stock that is whose return is higher than this line, after you calculate the return, and well, I won't say after you calculate the return, I would say that the return that asset managers are giving, if you plot it, and the graph, and the values are above this line, the stock is undervalued, because it's above the security line. If it's under, it's overvalued. Sorry, if it's above the line, it's undervalued. If it's below, it is overvalued. And the security market line, the horizontal axis, you see the stock beta, and the vertical axis tell the returns. we look at the return, you can see that this is the market return, which is 1. Any stock that has a beta of bigger than 1 is more risky than the market, and therefore the return will be higher, go up. If it is below 1.0, that means it is less risky than the market, and the return will be lower. Okay. So there are a few more things you need to know about the security market line. So it shows the levels of systemic or market risk of various marketable securities plotted against the expected return on the entire market at the given time. Okay, I have already explained what the x-axis and the y-axis show. X-axis show the risk or the beta, and the y-axis show the expected return on that asset. Okay, all right, good. Now, the market premium of a given security is also determined where it is plotted on the chart relative to the security market line. So I think I mentioned this already. So money managers and investors in general use the security market line to evaluate an investment, a stock, an asset, investment products that they want to buy. They use the capital asset pricing model or the security market line to evaluate it. If you want to, especially if they want to add that stock to the portfolio that they have. So when the security is plotted on the security market line chart, if it appears above the security market line, like I explained earlier, then it is considered undervalued. Why? Because the portfolio on the chart indicates that the security offers a greater return against its inherent risk. Okay. Now, vice versa, if it is the security plot below the security market line, in that case, it is overvalued. Okay. So we can now proceed to the next area, which is some of the key components of the capital asset market pricing model. First part, if you look at the formula, like I explained a few minutes ago, when you look at the formula, it has the risk-free rate, then beta, the market risk, market return minus risk-free rate. So let's look at the beta first while looking at the components. Beta is a measure of the securities systemic risk, which is the market risk. And it cannot be eliminated by diversification. I believe I explained that in my previous lecture. It cannot be eliminated by diversification. If the beta, for example, if the beta is 0.5, if we look at the security market line, you can see they say that this is 1.0 for the market, it's halfway, 0.5. In that case, it's less risky than the market. It is half as risky as the market. So the return will be lower. Okay? So that security is half as volatile or risky as the market. If the beta of that security is 1, that means it has the same risk as the market. And if the beta is 2.0, it is twice as risky as the market. Now, that's the section that we call the risk premium in the formula, if you look at it, which is this part. Okay, this one here. Okay, that section is the additional return required to compensate investors for assuming a given level of risk. That is what that section represents. Yeah, the additional return required to compensate investors for a given level of risk. Yeah. Now, so basically, what the capital asset pricing model or the security market line equation is telling us is that the required or the expected rate of return on a given security, which is a stock or any stock, mainly stock. So it is telling us that the required or expected rate of return on that security is equal to the return required for the securities that have no risk, plus the risk premium required by investors for assuming the risk of buying that security. So that means the higher the one more thing is this: given this the nature of the equation, you can see right here, this will tell us that the higher the beta, see the way where it is located, and you're going to use it to multiply the risk premium. So it basically tells us that the higher the degree of systemic risk, that means the higher the beta, the higher the return that they are on a given security. That is, the higher the return that investors will demand of a given security. Because the higher the beta, the higher the risk. Okay, I believe I have given you enough background. Let's do some math. Let's do some, then apply this to various situations. Okay. The first question we answer in that regard is this one here. So if the risk-free rate is 6%, and the market return is 10%, calculate the required rate of return of the following investments. I mean, so what return would the investors demand before agreeing to invest in that security? So they say this is security A. A can be maybe Walmart, B can be Home Depot, C can be any stock, as a matter of fact. So I'm gonna write some of this. It says you are giving the beta and you're giving the risk-free rate. So I'm gonna write some of this thing down so that we can put them in Excel or use the formula to calculate it. The beta. So we have security A, B, C, and D. A is 0.53, B is 1.35, C is 0.85, and D is, like I said, A can be Walmart, B can be Home Depot, C can be Bank of America, D can be Capital One, any security at all, okay? 1.05. So to calculate this, we are giving the risk-free rate RF as 6%. And the market return RM is 10%. Okay. Now to calculate this, you can see the formula right here. RJ equals RF plus beta, RM minus RF. So you plug in all these values plus the betas into the formula and get it right. So you can see, for example, this one, risk-free rate is 6%. Beta for the first stock is A, which is 0.53. You can see right here. Then it said RF minus RM. RF is 10%, which is 0.10 minus 0.60. Let me write it down so we can put it on a calculator. Then get the answer. Then I will show you how to do it using Excel. Okay. So we go to our calculator and put this first one in. I'll have this in this form. Okay, gonna be 0.06. 0.06. Make sure I'm seeing this. Okay. My plus got, okay, so plus 0.53 times, okay, 0.10 minus 0.06. I see 0.0812. That means 0.81%. That means 81%, 8.1%. Okay, 0.0812, which is 8.12%. And you can see it on here, 8.12%. Now, let's go to the Excel and put all this in Excel, so you can get all of them at once. I've shown you how to get each individually. So taking it to Excel, I will have the beta for stock A is 0.53, for stock B is 1.35. For stock C is 0.85. For stock D is 1.08. Okay. Now, the risk-free rates, they give us the risk-free rates. If you look at the question, okay, you see that the risk-free rate is 6% and market return is 10%. Okay. The risk-free rate is 6%, which is 0.06, and market return is 0.10%. Okay. So, I think I'm gonna just remove this and put them here. Risk-free rate is 6%, 0.06. So for all of them, going to be 0.06, copy them. Market return is 10%, which is 0.10. Okay, 0.10. Put it right here. Then we can use this formula to calculate the return, expected return, required rate of return on all these stocks using this formula. So equal, I hope you are paying attention. See. So remember, before you do any calculation in Excel, put the equal sign first. So equal risk-free rates, which is RF, is this here, plus, okay, we have beta, okay, times, asterisk times, then RM minus RF. RM is market return minus risk-free rate of RF. Then you close it twice to make sure that it balance. Okay, sure you can see this. Okay, good. And see right here. And then press the enter key. Give you the result, say 8.12%. And highlight it, copy them down, calculate this rest of them. But for stock B, what they require is 11.4. Let me highlight it so you can see all of it. 11.4% for stock C is 9.4%, and for stock D is 10.32%. When you look at this, okay, see, this make it very easy. And you can see that I have the same answers when I did manually with calculator in my presentation. I hope you're having fun so far. Okay, let's look at this one. It says, calculate the required rate of return of a security using the security market line approach. If the risk-free rate is 8%, market return is 12%, and the beta of the stock is 1.5%. Then they ask you, is the security undervalued or overvalued? Again, look at the formula we use here. And our risk-free rate is 8%. So RF is 8%. And the market return is 12%. RM is 12%. And the beta of the stock is 1.5. B is 1.5. You can see them all right here. I believe you can see them very clearly. Very good. Very good. So that means next is now to get plug them into this formula. So that we have 0.08 for the RF. For beta, we have 1.5. Market return have RM, which is 12% minus 8% for the risk-free rate. So we have the required rate of return is 0.08 plus 1.5 times 0.12 minus 0.08. And we'll plug this into our calculator for this particular stock. Okay, we have it as 0.08 plus, okay, beta of 1.5 times, okay, 0.12, which is the market return minus a risk-free rate of 0.08 again. Okay, you can see the 14% right here. And I also have it done in my presentation. Okay, 14%. Now, it says, we answered the first part. The second part says, is the security undervalued or overvalued? Well, is it undervalued or overvalued? If it is 9%, I think I missed something here. Okay, now if the actual return, what I missed here is writing if the actual, if it says that is the security undervalued or overvalued, if the actual return okay, return is 9%. Okay. So I'm going to save it. That's what I missed. So now, if the actual return is 9%, is the security overvalued or undervalued? Well, as I explained, the value we have is 14%, which is bigger than 9%. Which, when you look at the security market line, again, it will be above the security market line. Our answer is because the actual return is 9%, but ours is above it. That means the stock is undervalued. Okay, it is undervalued because the position of the chart, the position of our answer in the chart indicate that that security offers a greater return against the inherent risk. Okay, so it's undervalued. Sorry, overvalued, not actually undervalued. Yeah, our answer is above that, so it is overvalued. Yeah, we look at here, you can see that it is overvalued since their answer is bigger, but the actual return is lower. Okay, it's undervalued, not overvalued. A mistake. All right, because the return is 9%, but what is our model showed that you should have returned 14%, so it's undervalued. Okay. All right, look at this one. It says a stock has a beta of 0.8. Assume that the risk-free rate is 5.5% and the market return is 6%. Market premium is 6%. What is the stock required rate of return? Okay, good. Now, when they say market premium, they're talking about the whole of this place. And they say that it is 6%, so you put 6% right there. Put your beta here. And the risk-free rate is 5.5%, which is here. So when you plug this in and put it in the calculator, you're going to get 0.103, which is 10%, 10.3%. Okay. A natural question that will arise now is, how can we use this? I mean, I'm giving you examples. Suppose you want to evaluate a stock like Walmart using this model. How do we do it? To do that, you need only 3 things. The first one is, give me 1 minute, make sure you're seeing this. The first one is the risk-free rate, RF. Second one is the expected market return. And the third one is the beta. Let's start with the risk-free rate. So this is the stock you want to expect. It's Walmart again. So for the risk-free rate, we use the return on any of the treasury bond. Now, I think I've showed you where you can locate it in the Yahoo Finance. But actually, as a matter of fact, you can get the return on treasury bond for various periods by reading some of the Financial Times, like a Wall Street Journal. You can get the return from there, or you can get it actually online from some of the. There are a lot of publications online that have those values. But I usually rely on actually calculating it myself using the period of my choice. To do that, I'll just go to Yahoo Finance And then I'll just go to choose the return on treasury bond, which is 10-year bond. Okay, I click on it and then look at the historical data for that. See, this normally I use adjusted close and then use it to calculate my return. I can say the return from 2012, 2021. I can use the return on equal of 2022 or between 2021 and 2022 as my risk-free rate. To calculate this return, you can just download this from here. It will go to Excel. Once you click download now, it will go take you to Excel and have all these values. And you can choose this one to calculate the return. I think I have explained how to calculate the return, and average return and expected return before in my previous lectures. I encourage you to watch those lectures, how to calculate the return. So that will give us the return, the risk-free rate. Then for the expected market return, RM, you can use the return on any of the market indices. For me, I normally use the S&P 500, depending on the kind of the company that is the stock that I'm working on. If I'm working on technology stock, I can use the return on NASDAQ, which is we track tech stocks. If it's a manufacturing industry, I might use the return on Dow Jones Industrial Average. Of course, I think you get the point. Now, you get the return, calculate the return, and get it here. And for the beta, since this is the stock I'm working on is Walmart, I'm going to go to Walmart. They use the return on the same periods that I use for both my risk-free rates and for my market index from return on 2021 to 2022. December 2021 to December 2022. So it's Walmart. I'm going to open the historical data, make it monthly data. I can choose monthly data. I've already explained this before when I was calculating. I was teaching you how to calculate returns and expected return and average returns. I use this adjusted market close to calculate the return. Okay, on the end. Sorry, my mistake. I don't need the return on Walmart. This is my mistake. Sorry. For Walmart, what we need is the beta, not the return. I can just use the beta, okay, for Walmart. So all you gotta do is to open up Walmart, click on statistics, and you can see the beta right here. See the beta. For any company, you can open it. If you open the that is traded in the index and the stock market, you can open it and get the beta. So once I get all these values, I can just plug them in here into this formula to get the required rate of return. So I believe you get the point. And this concludes our lecture for today. I hope you enjoy my lecture today, and I encourage you to watch it and expect more lectures, and also to subscribe to my channel, of course, so that you'll be notified each time I have a new lecture. Thank you for listening, and I will see you in my next lecture. Bye-bye.